Hey, Alpha fam, welcome back to another episode of Alpha Commission. Today it's a beautiful day out here in California, just absolutely perfect, and I've got my allergies acting up, so pardon if I cough or anything, but sometimes beauty has its cost, right? So, of course, I want to get outside and be in the sunshine this Sunday, so I'm going to keep this as short as possible, but I did want to just go over a couple things that I think is very relevant to both our macro thinking and then also, of course, just the local move, what we could probably expect for the next week or two as we build up to the next Federal Reserve decision on interest rates, and of course the CPI data, all of those things which will control us along with the continuous earnings reports of the various companies that are reporting in stocks, which have, of course, contributed to some shocks in the market, such as because of Walmart, Target, Tesla, Apple, etc., all having bad news. As these stocks are reporting bad news, we are going to see the market continuously losing confidence. And unless we get some really good news, I really don't think this trend is going to change. But our focus here is on Bitcoin and on the crypto market, just for the weekend, especially since the markets really aren't doing that much. You can go ahead and take a look at some previous videos if you want to hear more market analysis. But just for today, let's talk about crypto. And we look at Bitcoin because, of course, it does lead the charts. Most money is flowing into Bitcoin right now. And it's either that or they're taking it out of the market and putting it in, either USDT or just cash, right? But let's go ahead and take a look at the whole history of Bitcoin. And what we can see is that on a macroscopic level, it's always been, a safe bet to buy, somewhere below or around the 786 and even occasionally the 886, although the only real time of that was in 2011, which if you were blessed to buy back then congratulations. Not sure that we're going to see that. For the rest of us, I think the 786 is a reasonable target, but let's take a look. Okay, if we go ahead and just zoom in here, we can see if we take it from the low to the high of just that kind of swing arc, then you can see that price action came all the way down past the 786, approached the 886, and in this first cycle really exceeded it. And so, oh boy, if you had a chance to buy in there at $2.69, okay, let's move on. I'm going to get depressed looking at that. But in this second era, you can see taking the low to the high again, we did see a complete retrace all the way down to the 786, and then attempted to reach that 786. And although we never got there, we did find ourselves between those two key, fib measures. And so if you had just, had the intestinal fortitude to pull the trigger and bought there, it could have been the buy of your life at $189. Okay, still feeling depressed. Second cycle, take the low to the high. What we can see, of course, is that once again, we just blow past that 786, try to reach for that 886, kind of, trying to recreate that pattern from the first cycle. And we just end up somewhere in the middle. And again, if you had the balls to pull the trigger, then you're going to get it at $3,500 and perhaps even a second chance around $4,000 during the COVID dump. So, what does that mean for us today? It means that if you really want to have the best chance to buy, then you're probably going to look at that, 786 level as a safe bet, and then perhaps somewhere, you know, lower than that, you may just want to have some type of purchase orders, right? So let's go ahead and take a look where that would put us. The 786 is right here at $18,000. And then, of course, that kind of stretch goal is somewhere around $14,000. And so that's your realistic price prediction, okay? You can see this price action here, it didn't sit on any type of consolidation area. It just stretched down there. All right. This, reach down here, it didn't sit on any, particular place. And it did go lower than this spike here. So, hey, very possible that we end up just, wicking past the previous, high there and not necessarily targeting any consolidation area, just having a wick. Same thing down here, just kind of did its own thing, right? There's literally no support or anything. It just ended up topping out where it did or bottoming out where it did. And so there's not necessarily going to be some logic of where you can buy the absolute bottom. You literally cannot time the absolute bottom. It could be that because we had these rounded tops and these double tops, and it's kind of like a soft, controlled market now, as opposed to these blow-off tops, that it could be that we end up getting front run, right? Maybe it's actually 22,000 or 23,000 ends up being the bottom, and this could be the first time that we're actually bottoming out above the 786. So having those DCA levels really isn't terrible because on average, you can see this was way below the 886. This pretty much was the 886, almost exactly. It just, you could fiddle with how you align these things and it would pretty much be the 886. This one was pretty much in between the 786 and the 886. And so we might just expect that Bitcoin is going to bottom down here around the 786, around $18,000. And, if this price action, if this bottom is getting higher over time, just like the tops are getting lower and the bottom is getting higher, then perhaps, again, like having that safe range that I've been telling you guys of around like a 23,000 to $14,000 is very super realistic. And the only reason I would ever consider lower than that is, of course, if there was some type of, great recession, that global recession, that almost depression level, like craziness in the market that really just brings us all the way back. But there's also that edge to it where the Federal Reserve may not come in to rescue markets this time. And if that's the case, then we could see something more traumatic than you might expect. Okay? Like I hear a lot of people saying, and again, I just repeated it, but I hear a lot of people saying that because the tops are getting softer, probably the bottoms are getting softer as well. Um, while I can repeat that logic and present it to you just for fairness, one thing that I would say is that tops getting softer doesn't necessarily mean that bottoms are getting softer, right? Like if you have a restraint on a market, that doesn't necessarily restrain the bottom of the market. It just restrains the growth, right? It's restraining the expansion of it. That could actually end up sharpening the bottom. Do you understand what I'm saying? So, yes, I hear the argument, and even I can make the argument that institutions have gotten into the market and they would prefer to have sine waves, right? I've made this argument before that the market would prefer to have sine waves that are kind of gentle rather than having blow off tops and then crypto winters, right? Like that's just incredibly traumatic for business. But the problem is that's for normal times, right? In extreme times where they're focused on other things than these super risky assets, they're more focused on, just the profit and loss of very basic secure assets, then there may be a certain type of negligence towards assets like Bitcoin and crypto in general, where they just allow it to die. Okay, because nobody really wants to be putting their resources into super risky assets if the world already has a tremendous amount of risk being built into it from every side of the market, everywhere. they're going to need to cut down the risk. And so, while I would make the case that big money came in, around here, and they started to like try to make like this kind of like a sine wave kind of curving market, as opposed to blow off tops, and as opposed to crypto winters. I think right here is where we basically failed, and now we can potentially see the chance for some type of a blowout bottom, right? It's possible, just possible, because the sine wave has been broken, right? Like this is no longer necessarily a proper theory. Um, we can look at it on a bigger time scale, and on a bigger time scale, it actually, looks pretty good, right? But that could still imply a pretty big, retracement as being possible at any one time, right? So you wouldn't know. You wouldn't know if there is a true, just devastating event in the market. You still have to consider that these kind of deviations, even on a gentle sine wave cycle, you're going to have these type of deviations. And so you want to just to be ready conceptually in your mind, uh, primarily for the fear of it. But also, if you have a chance to buy in, you would want to be just ready for any type of dip that we might have below this kind of gentle sine wave area. And so, of course, I'm also going to be talking about $10,000. And then, even I think there's a hypothetical bottom, in my opinion, around like $5,000, which I know people don't want to hear that stuff, but I just think it is hypothetically possible. I don't believe that's what's going to happen. I already told you that I primarily think that planning around this area is probably your best bet. And then, of course, I mentioned that the market could front run us and maybe 23,000, right? So this is mostly the range that I'm looking at, 23 to 14. And if you want to do most of your DCA in that area, that makes sense. Um, if you're, working a job and you're putting some savings behind you, then, could you pocket some, rainy day money just in case, we do have some type of really serious traumatic crash in the market and you're able to hit some of these lower levels, then yeah, why not? We see these type of deviations like all the time, even on kind of gentle curves, right? So if we happen to have, a deviation like down here on one of these, even if the market intended to make a smooth curve, right? If we end up having like some crazy thing just happen in the market, then, you know, hey, you might want to have a couple extra bucks ready. So most traders will have about 20% of their cash ready to deploy at any one time. They're not going to just max out um, on any one trade or any one DCA spot. They're always going to have, some type of capital ready just in case there is a dip bigger than what was expected, or just if there's just an amazing opportunity that comes up. And that would be one to exceed the 886. We have seen Bitcoin do it before, only once, but we have seen it do it before. And so there is the possibility in a traumatic downturn that it could do it again. But more realistically, we've been seeing the bottom move up and up and up. And so, above the 786 is a very safe bet. And then slightly below the 786, that $18,000 area, right? And slightly below, maybe like 15,000. That's, within that kind of expected range, right? That expected range. But I'm not going to spend too much more time on the macro. I think I've given you many, many ways to look at the market for the macro. And of course, we could even consider that this is kind of a fake out. So I am of the mind that like the market might be measuring from a hypothetical blow off top. And I've discussed this at length in other videos where this is kind of like a delayed blow off top, right? Where instead of having a blow off top in the market, we actually had a double top. And so the actual top may have been somewhere like right here. And if that was the case, then we might measure like this, and then you could hypothetically think that we've actually already hit the 786. So do you see why those DCA points that I made are so important? Because if this was actually kind of a hidden blow off top, and these market makers or billionaires or whatever are just using right the same logic as if there was a blow off top. It's just that sort of like if you could imagine like if this had a rounded top, right, like this. And then you could see that you can kind of see what I'm talking about, right? Like that's what I'm imagining there. And so, yeah, the 786 still is relevant, and maybe the next move down really is that price in between the 786 and the 886, which would be that 22 to 23,000. And of course, you could still have a stretch goal of like 18,000. But if you wanted a really safe range to just, DCA in, just based upon the statistics and some type of, theory to it, which, would be just a conservative concept, right? Because we're talking about raising the floor here. Then, we almost like hit the 786 on the dot. And if we had one more drive down, that would put us very much in line with the bottom of the market. And we would also not violate that principle of not breaking the previous all-time high, which many people like to talk about. And so, yeah, guys, consider it. Just consider it. But moving on from macro, let's go ahead and take a look at the local. What you can see on the local is actually, let me just get rid of some of this stuff using the other chart for it. Let's see, let's go to the 4-hour. What you can see on the local here is we still kind of have that bear flag being put in where the measured move is something like this. And of course, that would bring us to that $22,000, $23,000 level that I was talking about. And what would we be on the lookout for that? Of course, we would be looking to see if we broke 28,000. Let's see, where's this wick right here? Let's say 27,900. Anything below that could be a stop loss hunt. A lot of people have their stop losses below this price action. And so, any price action below 27,900, I would say we're perhaps in danger of fulfilling this bear flag. But until then, we actually do have a pretty good setup, kind of similar to the one that we've seen on in January, right here, like around January 31st, where we kind of had this slow build up, maybe a fake out to the downside, and then we had like a pop up, right? And that pop up was approximately 20%. And so I wouldn't put us past us to have like a fake out to the downside, maybe a quick wick or something to 28,000 or something, just to like hit all the stop losses of all the people I was talking about, and then perhaps a pump up, perhaps 20%, which would be something like let's see, where's 20%? Like $34,000 perhaps, maybe 35,000. Somewhere in that area of that CME gap that I was talking about. And you can see that we do have a very, very similar setup. We do have the MACD finally getting enough momentum to perhaps carry us forward. We do have the ADX considering to start moving in a positive direction. We do have the oscillators coming together. This is kind of a weak move, but it could improve. This doesn't look the healthiest, but it could improve. Both back here in January, we did end up breaking out of the bearish control zone. We are right at the top of that bearish control zone on the daily. Let's take a look at some of these other. We do have a very similar setup on the volatility and the Stokes. And then our directional volatility is pointed up. So yeah, I would just suggest that we have a very high likelihood, a very good chance of perhaps putting a 20% move to the upside, just based upon these key measures. Very similar to what happened here, right? And then, of course, we continued on our way, right? Like, that didn't last very long. So could we be doing something like that? And maybe in the next week or so, we end up building up that base to get that 20%. And then we end up, continuing down or doing something interesting. And maybe that was the bottom. I don't know, right? I showed you why it could have been the bottom. But I just don't trust the market. I do think that there is another pull to the downside. I think this is probably going to play out. But my opinion doesn't matter. It only matters what the market actually does, and we can take that day by day. And what the market is telling me right now is that most likely we could see something like this. And the only thing that would kill this pump is perhaps if the Fed came out or if there was some bad news in the markets. I think the biggest thing that I'd be worried about would be these earning reports that tend to be extremely bearish right now. You saw how the Walmart news and Tesla and some of these other things just kind of keep slapping down the market really hard. Okay. Or perhaps there's another rug pull with something like Luna or something like that. And, just confidence just flees the market, right? But one thing that gives me hope that this pump could actually go forward, even though it doesn't have to. Again, in 2008, we also had 2018, we also had a very similar setup, but it just continued to the downside. Oh, and one thing, just before I move on, one thing that I wanted to take a look at was just our EMAs. And you can see also very similarly, the 200 EMA was way overhead. All of these EMAs were in perfect, alignment, being splayed out to the downside. And so price action just wanted to check all the EMAs because we hadn't checked back with the EMAs for quite some time. It has been quite some time since we've checked back with all the EMAs. And so really trying to put in a stretch to these upper areas would not be unreasonable. In 2018, we just weren't able to make it to the 200s, and we continued sliding to the downside. I think that may be what's going to be happening here, but we would have to watch out. If we do end up being able to hold 35,000, 36,000, then there is a good chance that we could continue to the upside, in fact. So pay attention to 35 to 36 and see if we can really hold that area. If we can hold it, then maybe this was the bottom, guys. But if not, most likely we're just going to be popping up and then continuing on our way down. And then whether we go up or down just depends upon, the Fed and CPI data, um, different max pain, different whether or not inflation, whether we've reached peak inflation, or any of these earning reports, or perhaps some type of war news, etc. So there's just a lot of factors up in the air, and most of them point kind of bearish. Let's go ahead and just take a look at the DXY, the dollar. One thing that I was noticing is that, of course, everyone's saying it looks kind of toppy right now, and so it would be great for it to continue to pull back. It doesn't have to do that. It could literally just keep on going and suppressing this market. The dollar strength does typically suppress the stock and crypto markets. It doesn't always, but it typically does. And so we would like to see some relief from the US dollar. And of course, if cash is king right now, there's not much we can do about that. But let's go ahead and look at the monthly, because this was a very interesting look here. And you can see this kind of shooting star, right, that we're putting here, and that typically does suggest a reversal of sorts. So we have about 9 days to go. Depending on how this closes, it could indicate a pretty strong pullback. And where could that pullback be? I don't know, maybe to $98, right? I mean, it doesn't have to go that low, but you can see it tends to pull back to the 10 here at a minimum. See these pullbacks, and then it might continue. But this is a nice thing to see on the monthly, because it could suggest that we are going to get a bit of a run, that we could get some relief, and that maybe it's going to check back to the to the 10 even, sort of like back here. But we'll find out. We'll find out. And I don't expect the world to just flee the dollar, and this could take quite a lot of time. So if we get some relief from that, this just means that there's a little bit less pressure on us. And it's probably why we just stopped just outright dumping. And then let's take a look at volatility. There's the VIX. And volatility is also coming down. Let me put that on the daily. This looks, I mean, this doesn't look bearish or anything, okay? So I could see volatility increasing, but we'll just have to wait for next week to really understand. This really has kind of a saucer bottom. It looks like it wants to continue to the upside. Again, I really don't think this is topped out unless we've got that kind of 40 to 45-ish region. And you can see these massive peaks even get up to 90. And if the volatility ever gets in these areas, it's just really bad for the markets. But right now we are in at least a tradable area. So optimism for the beginning of the week. Okay, guys, gonna end it here. A little bit of optimism. Stocks not looking great, but they did find support, like I mentioned in the last video. No, Bitcoin has not decoupled from the stock market. Stocks just kind of found their bottom. The thing is, they broke the bottom, and so that would suggest, even if there's going to be some type of a bounce, that eventually they're going to work their way down lower to the next level down. Because once you lose support, it's just kind of a thing in the stock markets. They tend to come back down and explore that, and check out the lower level. So we didn't hold, we broke down, so most likely eventually we are going to check out that lower level, even if we do have kind of a bounce this week, or even if we make that W that I was talking about in stocks, and we could have a nice run, which could help also propel Bitcoin along. I would expect perhaps something like that, best case scenario right now. Just personally, that's my outlook. You guys decide what you are going to think about the market and how you feel about things right now. Have your game plan in order. And that was your alpha for the day. Stay safe and happy trading, guys.